Kia ora, everyone. Welcome to round 5 of Campbelltown Australs. The motion that is being debated by these two teams is that we support the advent of decentralized financial systems. That we support the advent of decentralized financial systems. I'd like to welcome the first speaker of the Affirming team.
Hello, just to clearly check, am I audible? Okay. So, before I begin my speech, gender pronouns he, they, starting in a bit. Starting my speech in 3, 2, 1. The problem with the status quo is that big banks has failed millions and thousands of people. Discriminating against individuals who have no ability to access lines of credit that would have been useful for starting up businesses and savings of individuals. It has also propped up recessions as a result of the shoddy rent-seeking behavior that these banks engage in. What do we support, and what does the advent of decentralized financial systems look like? So we would support other alternative means where people can invest and put their savings in. Things such as cryptocurrencies and digital assets, investments into things such as peer-to-peer lending services, things such as credit unions as well, all of which challenge the traditional financial system of banks where they do offer similar financial services but just under a different platform. I want to make something very clear. So this is a challenge to traditional financial systems, but we still imagine people still using banks. The difference is on that under our side, it is not the primary means where people are able to invest or save, which means that people are able to diversify across many different financial systems, which is the alternative that we support. And something that we'll argue later on is that banks are probably going to be more benevolent as a result of the increased optionality and competition. A couple of other bits of setup. So the advent also comes with the boom in information about these products and alternative financial systems, such as financial literacy programs, online workshops, people within the community sharing about their experiences with Cardano, Bitcoin, and all of these other markets. And additionally, take note that on both sides of the house, decentralized financial systems are going to exist. But the difference is the advent, meaning that what changes under our side is one, the amount of users that are entering and participating within decentralized financial institutions, and number two, the extent of transparency within them. With this, I'm going to forward two arguments. First, why we think that the alternative that negative has to defend creates market failure and financial meltdowns that harm the vast majority of people in the world. We think that there are many different problems that exist with the financial system. One, credit rating agencies that exclude the poor that are unbanked and can't access financial services because of the lack of credit history, which means that they aren't able to do things like start their own business and get out of poverty. This is the classic cyclical trap that prevents them from able to get out of their own socioeconomic position. Second of all, the rent-seeking behavior that goes on within financial systems, where a lot of the people in top positions want to prop up bubbles such as housing, which is what led to things like the subprime mortgage bubble, because people were too profit-seeking, which came at the expense of the rest of the economy and led to things like business shutdowns. Third, we think that they also have and exercise great power asymmetry, because the only means by which you're able to invest, the only means by which you're able to get a loan comes from a lot of these banks. They are your only source of liquidity. What that means is that banks are able to do things like set higher interest rates, are able to do things like make terms and conditions very vague against you, which is what oftentimes leads to the abuse and predatory practices that a lot of banks are able to engage in. But number four, we think that in times of recession, oftentimes they have a tendency to exacerbate and accelerate the rate at which that recession happens. Because, and as I will document, what ends up happening in a lot of these markets is that when there's a recession, there's reduced market confidence. When there's reduced market confidence, people have less trust within financial institutions, which means that there are bank runs and people pull out of those markets, which means that the fractional reserve banking of being able to give out other businesses loans also shut down, which creates a contagion effect in the rest of the market, which means that you get massive layoffs from a lot of different groups. But the last reason why it's problematic is because of the bundling of risks, right? Because oftentimes financial systems pool in risks together, as what we've seen in, for instance, private equity firms, which makes it so that there's a higher likelihood for things like default. Why do we think that this problem is unsolvable? Because we think that it's genuinely impossible to regulate, right? Because of one, the revolving door, which means that you can't get proper regulations and restrictions in terms of the capital market traditionally. But number two, oftentimes it's too big to fail. Even when governments attempt to respond to these specific actions, oftentimes they lead to counterintuitive or counterproductive actions that try to go against them. Take a look at what happened in post-2008, where the Lehman Brothers were bailed out despite them being the ones that were causing the whole crisis to begin with, right? This is the feedback loop that creates a lot of problems within the economy. And take note, the other response to that was also to create lower interest rates, which also feeds back into future recessions in the as time goes on, which means that you accelerate future problems and increase in compound risk over time. Why do we think, and this is where I transition to the second argument, that the alternative and the comparative that we have is significantly greater for the rest of the population? We think that one, we provide an actual alternative for the most vulnerable groups that have been traditionally excluded from the financial system because they're able to access digital currency. They're able to access peer-to-peer lending services that gets to do things such as, pay for their food, for instance, because they're able to take personal loans. They're able to do things like set up their own businesses, right? So you massively alleviate it once you create a circuit breaker within people's access to financial services because of the optionality and existence of multiple different digital markets. That means so that people are able to be better off. Now, I know what negative is going to say. They're going to say that a lot of decentralized financial institutions are going to be bad and incredibly volatile. Here are three mechanisms to suggest why you improve stability as a result of the advent. One, because we think that crypto agencies and startups create choices and options for people, which means that there's going to be competition between them to make these services as transparent as possible. Number two, we think that more users in the market strengthens the transparency of financial systems because now you create financial literacy programs. And take note that the second reason for this is that the strength of a currency and the strength of a financial system is contingent on the buy-in that those people have, right? Similar to traditional financial institutions. Like they tear apart insofar as all the users pull out. So the reverse effect happens because when you have crypto markets or digital markets or peer-to-peer lending services, it increases from the number of users that are participating in them. But the third reason why we think that it becomes incredibly more stable is because this is already being integrated by a lot of private markets. So this is to say that a lot of products are already being sold by having cryptocurrency as the medium of exchange. We are currently seeing cars being sold. We are currently seeing was technology being sold, right? Because now people agree that it's a medium of exchange, which means that it becomes more reliable because now you can use this to buy and purchase other things as a result. And I want to make the comparative very clear. Under both sides of the house, there are going to be sets of actors that are excluded from financial systems anyway. The difference under our side is you resolve the information asymmetry that people hold, given that the demand for financial services is inelastic, right? Like they can't not set up a business or else they're going to not be able to feed their families and employ a lot of people, which means that they're going to be massively screwed over by decentralized financial systems on their side that are unable to provide that information without the advent. Last reason why you think that it's better is because it forces traditional banking systems to compete and to be much faster and improve their financial services. Because in the instance where there is a scam, they're going to want to offer and make their loans a lot more favorable by lowering interest rates, right? That's the other thing. So the other mechanism here is that because they have to compete, then as a result, you're going to be forced to lower your interest rates or increase your financial services by expounding outwards, right? So going to rural areas to make sure that you're able to tap into the market of the poor. The reason why this doesn't exist in the status quo is one, as I mentioned previously, their market power is unchallenged given that the current financial system, the way how it works is that it's an oligopoly. When you increase the number of producers of financial services under our side, you decrease the price of loans and opportunities that you have for people. But second of all, so yeah, you accelerate it better on our side. But second of all, you have increased regulation because now, like, let's assume the argument of volatility again that our side could purport. We think that regulatory institutions are already forced to being adopted on our side. The FCC and other regulatory bodies in the EU, for instance, are recognizing the power that cryptocurrency and other digital assets have in the economy, which is why we're going to be seeing strengthened, I don't know, government intervention. But the difference is that it's not going to face the same problem with traditional financial institutions because, the revolving door can't be a problem of everything. And you don't have an issue of the institution being too big to fail because now everyone's diversified across multiple different platforms. For those reasons, affirm.
Thank you very much. I would like to welcome the first negating speaker.
Hey guys, 1 second. Okay, sorry. All good to go? Cool. All right. I'm going to start in 3, 2, 1. The advent of decentralized finance has meant that billions of dollars worth of capital and talent has gone into this niche industry, fueled by extravagant promises. Those are all people, and that is all money that could be working on other important projects and helping humanity. Which means that the burden on the other side is to show why the benefits of cryptocurrency are actually worth the squeeze. And we would point to on side negative the existence of out-and-out Ponzi schemes in many cases, the massive increase in carbon emissions, the better funding that occurs for criminals and terrorists, and the fact that at the end of the day, what you get is a complex mess of volatile cryptocurrencies and software that inevitably discovers why the regulation they were so eager to supersede was in fact necessary. Even if there were some problems with traditional finance, we'll show you there's pressure on traditional finance to improve. But even if that wasn't the case, we think that some of those harms just make it from day one not useful and not a good use of humanity's time. The first thing I'll do is just briefly do some setup on what DeFi is and like the kind of counterfactuals on both sides. Then I'll give you a suite of harms on climate change, on crime, on volatility within the system, on insurance and scams, and then finally I'll address their complaint about access. Firstly, on what is DeFi, obviously the idea here is that no one owns or controls this, and the system is distributed across many different multiple devices. We're talking about things like cryptocurrencies, various blockchain systems, and crucially, obviously, there's no central authority, which is to say there's kind of a set of basic rules, and it's kind of like hackers' rules from thereafter. You can kind of do whatever you want as long as you maintain within the core set of protocols that govern the system. Observations on what both sides have to support. Obviously, under their side, they have to support the status quo, which is a rise in advent of this stuff, and potentially a future positive trajectory, which is what they claim. Notably, as we'll explain later, they assert that Bitcoin will eventually challenge the banks and force them to improve, and have actually proved that explicitly. But they also make the errant claim that we have to necessarily also support a world where DeFi or Bitcoin exists. That is not true. We do not, as the negative, definitionally support the advent of cryptocurrencies, which means we just prefer if none of this stuff ever existed. If Satoshi Son remained like a dream that never occurred, we never have to deal with any of it, and we prefer centralized systems. Notably, given that a lot of the people who currently work in cryptocurrency and trying to improve it are people who might have gone to work in finance, under our side, we get to claim all those people would have worked in centralized finance and made the systems better. So we're not comparing between status quo centralization and then like their kind of in cryptocurrency, we're talking about like a much improved centralized system that's had a decade of further investment, all the investment that would have gone into cryptocurrency. So harms. First harm, simple one on climate change. Under centralized systems, in order to verify someone's identity, you just need to get their identity documents. You need to check in with the regulator. You can like call the cops if you think they're shifty. Under the cryptocurrency system, because there's no way of actually doing that, there's no engagement in official sources. You verify someone's identity when making a transaction by doing a tremendous amount of math, very complicated cryptography. And the idea is the more difficult it is to like do that cryptography, the easier it is to like and the fact that it is so expensive and computationally difficult to do that means that which means that you can verify people's identity because they have a particular key, and that key is the only solution to a particular equation. Also, we'd also point out that cryptocurrency often has to be mined, which is also incredibly energy intensive. Which is all of which to say is in order to run these systems properly, and just even the simple small scale advent that you've seen already, they use a tremendous amount of electrical energy, right? As much energy as the entire country of Chile, I believe, at the peak of crypto a couple of months ago. And the point there is like we do not need to be pumping more carbon emissions into the atmosphere. This needed to have benefits from the beginning and from the very earliest days in order to justify the massive increase in carbon emissions that it causes, because the every increase in carbon emission is obviously a set of species that dies out due to climate change or an increased risk of natural disasters for people in the poorest parts of the world to expose to the harms of climate change. Second argument, why this makes it easier to commit and act and aid crime. We point out because DeFi systems are often not, or rather, they don't require you to de-anonymize as centralized systems do, where you have to have like an actual name and stuff, and actual like documents that verify your identity. Because they're anonymous, they are not subject to AML/CTF rules, which say rules against money laundering and counterterrorism, which means that the first people who jump in and use these things are people who are one, technically savvy, and two, benefit the most from anonymity, which is to say professional criminals and large-scale terrorists who are interested in financing these things, financing their operations, because they can one, use use these systems to move money across borders. 2, they can do so anonymously. And 3, crucially, they can disguise the origin of funds and where those funds are going and their ultimate location. The point and the impact of this argument is obviously, to the extent, as we know, because this is where it began, which is on Silk Road, helping people deal drugs like order hitmen and share child exploitation material. All we have to do is point out, right, the very simple observation that if this crypto stuff enabled one extra terrorist attack, one extra, innocent death, one extra, pedophile ring that continues to be able to operate, well and able to, persist, it's just simply not worth the additional marginal benefit of a few extra people finding these tools exciting and potentially being able to transact properly. Next claim, next problem with this stuff, it's extremely volatile. Because these systems are decentralized, they don't have an easy way of inputting checks and balances. There's no central authority that can enforce a commonly accepted set of rules. You have to rely on the pre-existing codes, and there are limited incentives for any one person to fix the underlying code base or go below deep into the stack to fix problems, because no one owns it, no one would benefit from doing all of that work. But the thing we'd point compared to traditional systems is that central authorities like banks, for example, and banking systems are 1, subject to prudential regulation on the part of regulators. 2, because banking is often extremely politically sensitive, politicians have a strong incentive to make sure they're not messing around in there. 3, you can make them have capital requirements. You can subject them to Dodd-Frank reforms in the event of a major financial crisis. You can force them to do things. You know who their executives are. You can speak to them. You can put them in jail if need be. I'd note here just kind of in response almost is that a lot of their examples are from the GFC, which actually plays perfectly into our hands, right? 1, it was well over 10 years ago, and 2, there was a massive regulatory response to the set of poor practices there. There was an enormous amount of response to increase the amount of capital requirements. There's an enormous, much more amount of stress testing. Banks just can't make the kind of risks that they can right now. If you wanted a current day example of what the advent of these decentralized finance platforms look like, we point to the enormous explosion of FTX and the way in which that total lack of regulation and decentralization in the space ended up leading to many people losing their money, losing their livelihoods, and potentially becoming extremely upset. We would note that banking under either side is obviously a risky endeavor, but there are benefits to centralization. 3 of them with regards to the volatility of the overall system. 1, you have central banks who can be lenders of last resort. We note that some crypto firms actually try to do this in the wake of FTX's collapse, suggesting the lender of last resort is extremely important to both sides. 2, there are many brokers at lots of point, every transaction point in a centralized system. Each one of them has to keep collateral. That makes things harder. And 3, obviously you've got the federal deposit insurance, which makes it easy, means the governments can ensure that people aren't get scammed. Finally, on the question of scams, obviously some cryptocurrencies are explicitly Ponzi's, which is obviously the way, what happens when you just try and get people in order to sell them on, and then you eventually pull your money from the market and everyone else loses. Those are zero-sum games. They're clearly bad. I assume they don't actually defend those. But in a centralized system, you can obviously reverse transactions. You can go to the lawyers, you can seek legal recourse. Banks can notice fraudulent activity and undo when your credit card gets swiped, undo when your credit card has a mysterious pattern of transactions. Unfortunately, on their side, transactions are totally irreversible at the point of the blockchain. And the problem with that is 1, people get hacked. 2, people make mistakes literally all the time, even when they pay a lot of money to not make mistakes. And 3, you can just pay someone who doesn't, serve you the good that you were trying to transact, and there's literally no form of recourse. These things are very inefficient for that reason. There are many people who've already been scanned in the status quo that mean that many of the individual users of these platforms don't actually benefit from them. Finally, on questions of access, we would just point out that in order to access DeFi systems, you have to use centralized systems. You need a bank account yourself, which means anyone who can't access centralized systems under their side still can't use decentralized systems, which means they actually receive no genuine benefit from increasing people's access to financial services. These platforms are extremely bad for people generally. They're bad for the climate. They're bad for victims of crime. Couldn't be prouder to oppose.
Thank you very much. I'd like to welcome the second speaker of the Affirming team.
Hello. Okay. Hello, everyone. My name is Luigi. Preferred gender pronouns him, they. Yeah, I'm gonna start my speech. Okay, starting my speech in 3, 2, 1, and go. So this is not just a debate about crypto bros and FTX. This is a debate about a broader process that is finally adopting financial innovations in the internet sphere to create tools that allow individuals to access financial markets in a visceral and convenient way that never existed before. I will not allow this oversimplification of the crypto industry as just fraud alone. I think there's much more that we can say with the advent. I'm going to talk about two things in this speech. Number one, I'm going to talk about why this opens access to developing countries with weak fiat currencies. And number two, I'm going to talk about why federal reserves in developed countries are often disruptive for the developing world when you are in a centralized financial system. Before this, a few points of response. The first thing I want to respond to are all of the common significant accusations against cryptocurrencies. And I'm going to respond to this in a few ways. The first thing I want to say is that a significant amount of these risks are mitigated and are actually flipped and resolved in the process of development and continuous decentralization. And I do think a lot of these were already preempted by our first speaker, but allow me to highlight a specific things in the following. Firstly, the few specific mechanisms include more coins that are being created on a variety of different technologies or on a variety of different programs and open source platforms, allows more competition between these different crypto startups that allow more consumers to have more options to flock to a certain type of crypto that they're able to recognize is actually not a scam or is actually one that is more reliable by a vast number of individuals. Because the more individuals that subscribe to certain cryptocurrencies, it's kind of like the democratization of these systems allows more stability that is embedded into these systems as well. Secondly, more competition between large backing institutions against these smaller lending institutions also improves the large centralization system today. This is why I think it's a good thing that JP Morgan is adopting some cryptocurrencies and diversifying their mutual funds, because it is mutually self-reinforcing that they're able to make one another more stable so long as the latter is more accessible. Again, this is exclusive to decentralization, because when they are aware that Bitcoin is becoming used more as a technology that is used in consumer products and in global trade markets and global supply chains, then there is an incentive for those traditional banking systems to lower the interest rates, or at least make it easier to access those mutual funds that would have otherwise been more expensive if they were the sole monopolistic controllers over the financial system. What is the implication on this, on their problems on professional crime and environmental damage? For professional crime, this is mitigated when the code is made more open source and exchange platforms are integrated with more authentication processes. This is why in the competition between FTX and Binance was able to be more successful because they were more transparent, and they were able to cooperate more with governments in this process, even if they're a decentralized organization. Number two, environmental damage. We are seeing many cryptocurrencies created that are more environmentally safe. Cardano is a very popular eco-friendly example that is succeeding now, and it succeeded even longer than its counterparts like Solana. Number two, if you want to respond to the hype of crypto, again, the argument that people are just dumb in general and sometimes it causes a lot of risk, that exists on either side sometimes, but it is largely artificial on either side. I would argue that even if it is artificial and a lot of it is speculative, this public speculation from like the Reddit street bros and all of these people is easier to respond to compared to the non-transparent speculation that is inherent to financial bubbles that exist in large traditional banking markets, because people are unaware that the loans or mortgages that they buy themselves into are actually being pooled by these Wall Street vendors themselves. So I would just argue, if people are internalizing those risks and making the decisions themselves, it is one additional layer that makes it harder for most people to always be in a bubble together, because the risk is not as pooled as it would have otherwise been in a traditional banking system. Number two, Affirmative says that they can claim to have a more improved centralized system, like the Dodd-Frank reforms. I have a few responses to this. Number one, a lot of our problems that we mentioned from first speaker are inherent to the centralized system. Like, they're not resolved by just having like the argument that you send the crypto bros to Wall Street. Information asymmetries between lenders and borrowers, collusion in credit rating systems, rent-seeking behavior, risk pooling behavior that creates banks too big to fail, and they also disrupt government systems. This will not change if other crypto bros study finance degrees in Wall Street. In fact, we argued that the improved centralized system you need is improved by decentralization because of the competition that exists. But a lot of these regulations still exist for centralized systems. Like, I still think Dodd-Frank reforms will still exist. The Federal Reserve will still exist on our side. It's about the marginal change of behavior in banking systems on our side, which I'm going to argue and talk about now. All right, we're good on time management. Let's go. First argument. This is effective in opening access to developing countries with weak fiat currencies. The international financial system is largely reliant on the institution of the dollar, special drawing rights in the IMF, international foreign direct investment and loans being denominated in the dollar, and trade being largely made in the dollar as well. There are several problems inherent to the over-reliance on dollar markets. Weak fiat currencies are exposed to significant volatility since it leads to further disinvestment from foreign businesses, and their central banks are also incapable of holding a high amount of reserves since it's very expensive. Number two, these developing countries have incredibly weak import markets, which means they are illiquid when it comes to having enough purchasing power for different technologies and different goods and services from other countries. And lastly, the dollar reliance means that these states are substantially less in control of their fiscal and monetary policy because the efforts of the central bank to intentionally devalue or change the worth of the currency will often be futile compared to the Federal Reserve's efforts in the United States. Why then is a decentralization of financial systems a precondition for democratizing currency exchange markets? This provides, number one, state financial institutions with access to global markets and exchange rates across multiple countries, specifically on decentralized systems and with decentralized actors to directly access these respective businesses at lower transaction costs without having to go through the medium or the middleman of the dollar, eliciting trade on appropriate pricing due to higher levels of competition, thus increasing the purchasing power of these states. Like the short response is this increases the effectiveness of those multilateral trading agreements. But number two, this is done simultaneously while being able to dictate your exposure. Individual countries can choose their exposure to these systems, exposure being dictated by the level of decentralization that exists and by the multitude of different options that are available, compared to the alternative where the dollar is the only option. This provides states with significant flexibility and control over the value of their own currency markets, and it's a safer way to operate on currency flexibility to protect or encourage competition in export markets. What's the impact? While large developed countries that are dollar dominant may be pissed at this policy, this is incredible for providing more agency and access to developing country stakeholders across the developing world. They are more in number, they are more vulnerable, and they are the ones who have historically been locked out of financial systems through the Bretton Woods institutions that the US have imposed on these countries. Yes, I know El Salvador is the only example of the country we have right now, but we think these structures are also prospective for countries like Argentina, who also faced a currency crisis many years back and could do nothing, or countries like the Philippines who face for currency volatility as well. Decentralization provides them with more options. It makes them more liberal. Number two, why Federal Reserves in developing countries are often disruptive for the developing world. The problem with the centralization of financial markets is that the entire world is largely reliant on a singular institution, the Federal Reserve and Jerome Powell. Or if not Jerome Powell, at least the Federal Reserves of different countries with large currency markets like the pound or London financial systems. And this is evident with how the largest banks are concentrated in these places, like in Hong Kong, UK, or the US. This creates a significant conflict of interest in terms of regulation that is disruptive. The Federal Reserve is obligated to act in the interest of their domestic constituents, but at the same time, they impose policies on these large banks which substantially expose risk to loan and credit markets across the entirety of the developing world, which causes a significant trade imbalance, lower interest rate to combat inflation that leads to higher appreciated dollar domestically, but it substantially disrupts those economies that are also exposed to inflation in the developing world that holds assets denominated in dollar markets. That is exactly what we're seeing right now with the Federal Reserve in the United States. How do we change this? Again, the mechanisms I have mentioned to the entirety of this speech. We mitigate these risks substantially through the exposure to decentralized currencies and to the decentralized markets, through the competition mechanisms and everything that Garcia said. All good.
Thank you very much. I welcome the second negating speaker.
Have you unmuted that one? Just checking that I am audible. Thank you.
The advent of decentralized finance has led to new types of risk in a financial system through which billions of dollars are flowing in the most insecure and unsafe way possible. Plus, a lot of new variations of the old risks that we were worried about with centralized finance in the first place. In addition to that, the advent of this decentralized finance has prevented us from reaching the pinnacle of financial systems that would have led to more enjoyment for everybody, for every government, for every person who uses currency and uses money. Because instead we were wasting billions of dollars, man hours, and extreme amounts of opportunity costs on this stupid system of decentralized finance that has led to unending amounts of pain and instability for so many vulnerable actors in this debate. Finally, let's just clarify in setup that no, in our side of this debate, in a support motion, we are talking about a world where the advent of this technology never existed, so we don't have to defend anything to do with any decentralized finance. In our world, centralized finance would have been it, and all of the effort and all of the pain points that we felt about things like the fact that it was hard to do transactions at night or that they took a little bit of time would have been worked on within the centralized finance system, instead of us being like, oh, let's jump ships and, you know, try somewhere else, and then realizing that we jumped into an even bigger haystack of needles that had barely any straw in it at all, right? It was just a bunch of pain and like diseases and things that we couldn't possibly foresee. So next, onto the question of access. The first thing they say is that it's bad if centralized finance is all we have because it's less accessible. First reason for the individual is that because they are vulnerable to things like credit rating agencies, which means that poor people can't start businesses. The obvious response to this is that the ability to access a loan in the centralized finance system is a very sophisticated function of risk, and it is bad to give money to people who are not able to pay it back. That's how the financial crisis that this team was so worried about literally started. So if they say that their system is going to do more of that, more loans without checking whether people can actually pay them back, you're far more likely to end up in another big crisis where a lot of assets cannot be paid back to banks. But also, secondly, it is possible to increase access to things like loans in the centralized finance system through things like other technologies that don't rely on decentralized cryptocurrency. Like you can have, you know, and I'm sure Udai will tell you about them. We all do those debates about the ones where everybody's loans like all stack on top of each other and stuff like that. There are things that you can invent and test within centralized finance that are far more secure and far more safe. But the next thing that they told you was about developed countries and developing nations and governments themselves. They said it's really bad when all of the international community relies on the dollar. They said it's really bad for a couple of reasons. The first is that they are sort of subject to the volatility of a currency that they have no control over. This is completely uncomparative. First of all, the idea that it would be like that decentralized finance is an appropriate alternative to this is crazy, because it is even more vulnerable to all of the flaws that they said the US dollar is vulnerable to. That is to say that it is equally fluctuating outside of your control, right? However, it fluctuates much more wildly and much more dangerously and is going to cause much more financial crises, right? Because at least with the US dollar, there is a government who is in control of taking care of the value of that currency and keeping it stable. With decentralized finance, there is never going to be any centralized anything at the center of that, keeping the value of it stable, meaning that random usage fluctuations can massively change the value and would literally destroy like the entirety of international finance. You need to use something stable. Everybody needs to be able to use it. And importantly, it needs to be secure. The end impact of what I've proven here is that developing countries in a world with decentralized finance have equally non-existing control over, you know, their ability to sort of control their financial, currency and all that, because they end up using the dollars anyway, because they're not idiots. So at the end of that, it's really important to note that access wasn't better for poor people and it wasn't better for developing countries. But what did that come at the cost of? It came at the cost of fixing, of a lot of people feeling a lot of pain, right? Because decentralized finance has been very bad and has opened up a lot of usage because people got sort of swindled in because it felt attractive and exciting. That has led to a lot of loss. The first thing to say is that, one, smart contracts that are the basis of decentralized finance are extremely prone to flaws. They are prone to things like logic errors. They can be very exploitative when the pricing is mispriced, and they can also lead to things like flash loan attacks. The second thing to say is that the decentralized finance is incredibly reliant on outside information, such as, like, for example, getting a price feed in from a stock exchange. exchange. That is to say that you need third-party services like blockchain oracles who can feed in that information from the stock market in order to allow transactions to go through, which means if any of those ever breaks down, that transaction can't happen, which means that contracts fall through and the system becomes incredibly unstable. Suddenly, a bunch of people stop using that currency and it can have a tendency to collapse. That's why we all know that the graph of the value of cryptocurrency kind of usually looks like this. Boom, like it just absolutely falls apart. Third thing, there's issues with scaling of these currencies. Transaction costs actually get bigger and bigger the bigger a decentralized finance platform gets. So it's never going to get big enough to enjoy any of the benefits that this team wanted to tell you about. That is for the reason that it can never grow enough. It's got scaling issues, right? So because things like Ethereum sort of like rely on P2P like transactions, there's a limit to how many horizontal transactions per section they can actually get done, and it gets more expensive to maintain the more people jump onto that platform, which means that if it ever gets big enough to like scare the central banks, it's already a completely useless, inaccessible and expensive system anyway, and people start jumping ship. Fourthly, though, we think that it has problems with the custody of your money. This is where most of the pain to individuals actually happens, right? Because in decentralized finance, everybody has custody over their own assets. So we are like trusting like a million brains to be safe and smart and look after their money, not get scammed and not get robbed, rather than like trusting one super brain, like one big, really locked up, very, very safe bank that is holding all of the assets behind a bajillion walls of protection. Like we're talking absolute fortresses versus all of these individual people who have like one 256 character number that is the only thing that is protecting their money from anything. That can be lost, it can be stolen, it can be hacked, and it means that a lot of people have lost all of their assets in one go because they are the only custodians of their assets under this system. There isn't anybody smarter looking after it for them. Fifthly and finally, this is the clincher for these guys, decentralized finance is impossible to regulate. They told you that banks don't get regulated enough. This was the least comparative argument I've ever heard. Why? Because when you regulate decentralized finance too harshly, it kills innovation, they don't like it, and it's very, very easy for them to move, right? You can take a decentralized finance program and you can run it out of the Cayman Islands just as easy as you can run it out of New York. That means that New York can never smack down and regulate it because it just runs away. It's a nebulous blob, it's a cloud that you can't grab hold of, it's smoke. And that means that if you end up having to be too lenient, which leads to a system under which everybody can be excluded. The impact of this is that the system is overall inferior. There's more scams, more individual disasters. There's less stability. It's a more risky system. Individual lives are destroyed. Crime is greatly easier to commit. It's easier to engage in unjust behavior, and the world is a worse place. On the alternative, centralization is very good and would have continued to get even better because it would have regulated it more and put all of our time, energy, and attention towards it. We would have been able to continue making banks better. They would have competed with each other as they do in the status quo to drive interest rates down and to have fair T's and C's for their customers. They would have fixed problems like they already have with online banking and making 24/7 transactions available. They would have fixed all of the access problems that this team was so worried about, but they would have been subject to laws and courts. They would have had skin in the game and profit incentives that help them to have an incentive to keep everybody's money safe. You need someone to have that skin in the game to protect those assets. You need somebody with custody to be clever, to have interest, and to protect that money successfully. We were so proud to support a world where this disaster never happened. Absolute dumpster fire. So proud to support centralization.
Thank you very much. I'd like to welcome the third affirming speaker.
Hi, she, her for me. Starting my speech in 3, 2, 1. I suppose the question is if this is sufficiently secure. But before all of that, I want to note that all their harms on security and stability are massive only in a world where your risk is undiversified, which means that under their side, where you have zero alternative outside of central banks, that is a world where you are indeed susceptible to risk. But when you do not have or are not reliant on a central bank because you have your own digital wallet, you're able to invest in a crypto, then able to invest in peer-to-peer lending, and then able to invest in something else within the state. That means you are far more insulated from the worst case scenario of an economic collapse. Because even when the worst case scenario where there is volatility and people steal money, bring it to New York, we on Affirmative make it easier for people to manage or respond to volatility because of a more flexible and accessible exchange market. I.e., worst case scenario, everything is indeed a dumpster dumpster fire, which is the neg case, that means under our side, that dumpster fire is only one of 10 different wallets that you could have invested in. It is only one in the portfolio that you are able to utilize, as opposed to you solely being reliant on a central bank, not stealing your money, not committing white-collar crime. Therefore, 3 things in this speech. Firstly, resolving accessibility, being extremely charitable. I have been in the intro. Second, on instability. And lastly, on the alternative. But before that, what I want to point out is they have a weird claim at both first and second neg that we could have prioritized other industries like finance. This is extremely assertive that people would have moved on to other jobs. I'll just pause it. It's likely they just do not get jobs at all because A, it oftentimes is incredibly hard to move into finance at a point where it has a really high bar in terms of being employed for it. But also, secondly, I just do not think you have a lot of jobs there because there's extreme competition when there's only one industry. In our comparative, we likely would have had diversity. We currently have a diversified economic activity, and that's why under our side we create more jobs, just flipping the material coming from neg, and that is why it's credited as a substantive for us. First, on access. So this is where they do not have a direct response to the extension. Broadly, what we get from negative is 3 broad claims. The first is in tension with the second. First neg says that you don't get access under our side because you still need credit cards. And then second neg says, well, it's a sophisticated system, we should not allow them in. If you believe first negative that you still need credit cards to move into a decentralized financial system, then you are still able to identify yourself. All their harms about you not being caught does not exist because if you still need a credit card, your name is still there, you are still logged into it. So maybe I believe second neg a bit more that potentially is a more sophisticated system that you should not allow people in. 3 responses. A, first affirmative preempted this by explaining that we have additional financial literacy. Potentially under their side, they do not have these centralized financial systems, but people are still stupid with their money. Like you still have Wall Street, you still have people wanting to invest. All of these things, you do not have political will to add additional economic literacy because the advent of you being able to be responsible for your own money, the urge for you to become more flexible with your money, diversify your portfolio, never existed because you're just told you should just rely on the state can handle you, the state will always be stable. That means that under their side, when indeed it is possible that bailouts will have to happen, you have to increase interest rates and you have to have higher forms of inflation, you have no capability to insulate yourself. But in addition, when there are bank runs, which is the economic phenomenon where people are less trustworthy of the state and therefore withdraw a lot of money from central banks, and therefore there's less money in the system, and that's why you have economic collapse. People are more vulnerable to it. Under our side, people are more urged to understand it because of the advent forcing them to understand it a lot more. That's why even if potentially on either side people are stupid, under our side we have better forms of economic activity that stop them from doing this. But secondly, I just think it's perfectly fine. I think that even if they are potentially wrong in terms of their investments, you still have banks under our side, right? As we explain and the setup, these are things that can still ensure that the entire economic system can exist. But as I pointed out in my intro, in the worst case scenario where they do indeed collapse because of the accessibility of you being able to opt into different things, that does not harm you as much in terms of the ratio. And that is good because these individuals prioritize choice as opposed to the economic collapse that they say. The last thing they say under accessibility is the response to Luigi's claim, which I think is deeply insufficient. What they say is that crypto is incredibly fluctuating, more so than the dollar, but at least there's a government. The problem with this is the difference under our side is people indeed have flexibility. Under their side, because you have the US government forcing and telling people what they ought to believe and how they ought to allocate money, users cannot dictate how they exposed they are to this risk. That means that when the dollar goes down, that means that other individuals are never able to push against it. We are not saying that everything should be purely reliant on just the crypto. What we are saying is that there are multiple ways in which the actual financial system is able to decentralize, and that's where they're better able to stop themselves from this risk. Like the other example is that the IMF has been considering adopting crypto in its basket of currencies with special drawing rights. And that particularly is because they do understand that reliance on a single currency, especially the dollar, is itself particularly harmful. So maybe on our side, the crypto is not perfect, or we maybe cannot regulate cryptocurrencies and the wallets, but you can regulate the crypto exchange markets like Binance, which has proven to be very effective. But secondarily, even when you cannot fully do so, at the very least, individuals are able to have different capacities to be able to opt in. That means we do indeed have access on an individual level, because now the collapse of a central bank doesn't affect you as strongly as it does. But secondly, individual developing countries can now choose how much more decentralized currency they would want to invest in, or which coins they can invest in. That means under our side, we're better able to ensure that there is a democratization prioritization of economic development that is happening already at present. Note this outweighs the assumption of, oh, you're going to have white collar crimes or criminals using this for terrorist groups, because I think terrorist groups will probably be terrorist groups either way. I think they're probably illegal either way. I don't really understand why there's a change so massive in the debate. But secondly, even if it is crucial, I think under our side, these are more vulnerable actors and therefore ought to be prioritized. Secondly, on instability, the hugest defense of the, I just want to flag, I think that the strategy that NEG provides is just, it's a defense of the outcomes, but not so much the defense of their So they say it's likely to be unstable because it's very hard to identify people, which is why you're more likely to do money laundering. And that is the essence of their case. Everything else is reliant on that. 3 responses. A, again, it's not just crypto, right? Things like PayPal, things like P2P lending schemes still ask you to identify yourselves. And the reason for that is because individual financial actors want to be able to identify who uses their products because that's good business for them to be able to identify. What I'll flag here is the threshold of it is far lower compared to, say, banks that often force you to utilize credit scores that often are inaccurate because A, people just don't have credit cards, but secondly, people just oftentimes cannot apply for credit cards at all, and therefore their mechanisms for being able to identify how people are able to access it and are able to uplift themselves out of poverty are very, very insufficient. So under our side, we still can identify things. I think we probably still have legal standing. It's not to the extent where it's completely irrational. I think individual actors and individual exchange markets can probably still be able to identify you. But secondly, second affirmative, flip this, right? Under our side, you have more information and status quo precisely because of the competition. Banks would have been deeply opaque. There are 2 implications to this. The first is that there's an overburden on the financial system on negative that makes it far harder to regulate, which means that under their side, potentially you have some regulations. These are going to be imperfect in the alternative world because you're going to always make it super overheating, especially in the case where these states or these businesses or these banks rather are unable to fulfill the demand. But secondly, banks themselves also can do white collar crimes like see 2008. Second says, well, it only happens because people are stupid. We already dealt with that. But secondarily, I just think that it explains why banks themselves are oftentimes not trustworthy, even if they potentially are stable. The weighing here is laws potentially exist on either side, but there are incentives more on our side to make users identify themselves. But even when they do not, terrorists can do bad things either way, breaking the weighing coming from first negative. What we allow is using this against white collar crime, against banks that oftentimes do not have regulations at all. Regulations that they say only exist at a point where you compete with them. They say they're always going to compete with each other. That is incredibly unlikely at a point where they often have incentives to collude, often have incentives to centralize themselves. And that's why affirmative wins.
Thank you very much. I'd like to welcome the third negating speaker.
Hello, can I be heard? I'm going to begin this speech by dealing with the issue of access, and that is for the reason that this team relies very heavily on the idea that decentralized finance will prove as a challenge or will serve as a challenge to traditional financial system. If we can demonstrate that, in fact, DeFi is harder to access than traditional financial systems, that will then require them to demonstrate that their product is, on average, better than centralized finance for any of their benefits to accrue. Because if it is the case that it is worse on average than any centralized financial system product, then obviously you would prefer a world where people use the better product and not the worst product, but they get worse service. But it also means it's impossible for their competition mechanisms to apply, because if your product is worse, it obviously doesn't force existing products to improve in any way, and so none of those benefits can accrue. Why is it the case that access to DeFi is just harder than centralized finance? There are 2 aspects to this. Firstly, access to banking in general, we would point out that decentralized finance generally requires access to things like a computer, which is a thing that many people do not have access to. Centralized finance, however, just requires access to things like cash or goods, which are far easier to opt into. Secondly, we point out that often to buy things like crypto or to sign up to services like like they talk about, you need a credit card or you need a bank account in order to buy into those systems, which means you already need to be in the traditional financial system. But thirdly, we point out that there's a huge amount of complexity in their system that is often mitigated in our system because you can just talk to a branch manager or talk to a teller. On their side, you need to interpret a complex set of decentralized instructions. Their only responses is to say, well, there'll be incentives to make things very transparent. We think perhaps there are some incentives to do so, but that doesn't explain why you why you totally demystify the inherent complexity of this system. For those reasons, it's probably easier to engage in traditional finance. The second aspect of this is they suggest this is a unique way to access credit, but we point out that access to credit is just a result of market conditions, right? The reason people can't access credit right now is because banks view that it's too risky to give them a loan and that they wouldn't be able to make a return. They don't explain why a decentralized financial system would find these creditors any less risky and therefore why they'd be more willing to offer them credit. We would suggest that those things are likely to be very similar. If anything, banks are probably more willing to lend because, for example, the fact that they're much bigger means they can afford to take on larger risks than, for example, the individual lenders who are participating in a decentralized financial scheme, which means that it's again unclear why this gives them any additional benefit. And they rely very heavily on the idea that competition cannot occur in the status quo. But what they ignore is that centralized finance isn't like a singular system. There are, of course, a number, if not like hundreds or thousands of competing systems within centralized finance, right? Like all the banks are in competition with each other, and assertions at Third Affirmative that they obviously just all collude are insufficient to demonstrate why it would be the case that only decentralized finance would be able to be competition to these banks and the banks could not compete with each other. There are several reasons for that. Firstly, we would point out that just like one, why doesn't their own logic also apply to decentralized finance? Why wouldn't it just seek to immediately collude and rent seek in all the same ways? But secondly, we'd suggest that banks probably do not do these things because of things like antitrust regulation, because it's actually very hard to collude. Like, you know, it's kind of hard for many parties, like hundreds or thousands of banks, to all cooperate together. The game theory suggests one would betray each other to make a greater profit. And we just point out in general that there's probably at least some altruistic individuals involved in a, industry that employs millions, if not, tens of millions of people. The idea that they all manage to collude together seems unlikely, which means it's unclear why they address or achieve any of this additional competition. So let's now then go on to explain why it is that this is a worse product. The first thing I want to address is their big push at the end of the debate, which is on US dollar dominance and why the US dollar is so bad and we need alternatives. They identify a set of harms. The problem is they never explain why crypto would actually be a viable alternative to the US dollar. There are several problems. Firstly, we suggest that the reason the US dollar is the dominant currency is because it's what sellers want to be paid for when they sell goods, and therefore that unless you change sellers' minds and convince them they should instead accept a different currency, that is unlikely. We suggest the reason the US dollar is dominant is because it's backed by the US government and the US economy, which people perceive as very stable and very attractive. They don't explain why crypto would be seen as more stable or more attractive. We give you a host of reasons why crypto is very likely to be volatile and therefore unlikely to achieve those benefits. And also it seems unlikely it would achieve the level of buy-in that the US dollar has. And we point out, like, their logic should be applied and just allow these countries to use their own currency or any other currency that exists, because that would also allow them to escape US dollar dominance. The problem is no one else will accept it, which is why they must engage with the US dollar. That probably would not change. And it seems like this is a winner-takes-all system, which is why the US dollar is so dominant. They don't explain how they're able to win out over the US dollar in that way. But secondly, we suggest even if it was the case that you could replace the US dollar with a particular cryptocurrency, that does not explain why countries would gain more sovereignty or control as a result. Like maybe the US Federal Reserve wouldn't control that currency instead, but it would still be at the whims of markets or volatility or the largest investors in that currency who could obviously fluctuate the price of it. And they don't really suggest why those things would likely to be operating in a particularly useful way for them. The next thing I want to address is just their set of claims as to why banks are so bad in the status quo. Because note, we give a wealth of reasons as to why banks are generally pretty well regulated. And while they're obviously not perfect, they're probably better regulated and more stable than the cryptocurrencies and decentralized finance schemes that they have to defend. What are the reasons we give? We point out that governments have very strong reasons to want to regulate financial industries because consumers care a lot about their banks and the safety of those deposits, because they're often central to the economies of countries, and governments want to make sure that their economies are stable and functioning, and therefore they're likely to do things like require banks not to take on too much risk, to require that they have enough assets, etc. This team points to singular examples of failures like the GFC, which obviously did occur, but do not explain why that is an unavoidable problem that wouldn't comparatively happen more on their side, but just say that, well, this happened, so obviously it doesn't work. They secondly suggest that things like lobbying and regulatory capture mean that obviously regulation is impossible. They don't explain why decentralized finance could not engage in lobbying or could not also engage in regulatory capture, nor do they explain why those mechanisms outweigh things like huge consumer and voter pressure on governments to do something about these issues. And we'd say in the aftermath of the GFC, there was a response, there was additional regulation, and we saw, for example, improvements during the COVID recession where those kinds of collapses did not occur. We additionally point out that there's significant amounts of competition between banks that force them to be good, that there's central banks that act as a lender of last resort, which is crucially important because if you believe that there's still some level of risk and volatility on both sides, which is likely, then at least on our side, when there is a run on the bank or some sort of risk, there is a central bank that can bail you out or tide you over. On their side, they have nothing and their crypto schemes must go bust, which obviously loses them significant amounts of money. Lastly, we explain that there are schemes of insurance where brokers or federal or governments often back the system for the very reason they provide, that if it's too big to fail, that is good because it means that governments will step in to protect consumers. But on their side, if that perception does not exist, then when, for example, FTX goes bust and $32 billion vanishes overnight, consumers are left with nothing. That is far worse. The conclusion of this argument explains why our system is significantly more stable, and you ought to believe that it's preferable that people invest all their money in a centralized system where they're protected and regulated and guaranteed, rather than in the risky system that they set up. Finally, let's just go through the unique set of harms that we identify, which they respond to poorly. For example, we explain that their systems are likely to be heavily abused for the purposes of crime because they're anonymous, immutable, and allow for cross-border transactions. This is very useful for organized crime because now you can easily launder the money, which is the main incentive for committing those crimes in the first place. They say we could have user verification. Maybe you could, but it often doesn't seem to exist. And the only example they point to is PayPal, which is not a decentralized financial system. It's owned by PayPal. And finally, we point out that this means there's significantly more incentive to commit crime on their side because you can more easily profit, that there's a reduced capacity to catch people because often you do so through finances, and lastly, that money funds future crime. We also point to harms on the environment. They just assert that things will get better. We win this debate pretty clearly.
Thank you very much. I welcome the neg reply.
Can I be heard? Great. 1 second. Great. Okay. Let's start in 3, 2, 1. Side affirmative tell you the following story. In the world of traditional finance, we have a staid and restrictive system where people are not protected from the implications of financial and economic collapse. The subset of very poor people are locked out of the system, and the people in the developing world are far too subject to powerful Western central banks. Their claim then in this debate is that the advent of crypto promises a new world free from these problems. Side negative, firstly, identify a set of problems with the status quo of decentralized finance, and then explain why the future prospects for the industry are not particularly good, so that the problems that they identify with the status quo can never be ameliorated. The first harm that side negative identify is that decentralized finance causes a tremendous amount of climate emissions, and given the point in humanity's timescale with respect to climate change, any increase in emissions, especially one that, as first negative tells you, is as large as the size of the energy usage of a major middle-income country like Chile, is just an unacceptable risk for the planet and unacceptable risk for humankind. There is no response to this material except for some mitigation at second affirmative, where they say that some cryptocurrencies exist that will make this better. We would point out that this is a claim premised on the future and not the present, which will become important in weighing in a second. The second claim The second way in which side negative point out to current status quo harms is they point out that this significantly aids crime because it's decentralized, it's anonymous, and you can spread, and different criminal enterprises and terrorist networks can spread money. Third, there are kind of two responses here from side affirmative, both of which are mitigatory, claiming that in some cases you can verify identity, and then just kind of asserting that bad things happen under either side, which misses the fact that there are marginal increases in the ease of conducting crime and of getting away with crime for longer, which means that innocent people are harmed by criminals and terrorists far more under their side than side negatives. The third and final claim that negative make is to point out that the doctrine of not your keys, not your crypto means that people are required to have a high degree of individual responsibility for their own money and are often scammed and hacked in a variety of ways, none of which really receive a response beyond the promise that things will get better. And this is the crucial problem for affirmative. The die is already stacked against them because the status quo early set of world of decentralized finance is quite bad. They claim these are growing pains and eventually the system will get better. Let's examine that claim now. They say that increased access will force the banks to improve, which will solve a lot of the problems they identify in the status quo. Side negative make the simple observation that people who use arcane cryptocurrencies are either sophisticated institutional investors looking for return or hobbyists and rubes who clearly already have access to financial systems, which means they can't claim that this increases access and therefore places competition pressure on existing banks. But side negative go further. They also explain that the product is just genuinely worse, which is to say there's a tremendous amount of volatility in the space. There's often big players in one currency can massively move the price. There's a tremendous lack of insurance for transactions. There is a set of reasons as to why this is significantly less stable than pre-existing currencies. We point to probably as known to the average reasonable person that the price of many cryptocurrency goes like this, whereas the price of a fiat currency goes like this and is backed by centralized governments. And we point out that these set of problems in the status quo, with how decentralized this is, makes it quite unlikely that people will continue to buy into the future. And by comparison, a centralized system which can improve is comparatively far better. They say that they say that the future for crypto is better than the status quo. All we have to do is prove that centralized systems are responsive to regulatory change and pressure, which we've shown to no real sufficient response beyond the repetition of the idea that banks collude. And they have to defend a system where people often make mistakes, they're often defrauded, they trust the wrong crypto exchanges, they get hacked, they lose their coins, or they are subject to Ponzi schemes, many of which are harmful. And because the product is so bad, it is unlikely to improve. People are likely to buy into the way they need to in order for these products to improve. These products never improve, and the problems of the status quo they seek to solve haven't worked. Crypto has already demonstrated its harm. They haven't demonstrated sufficient future benefit, which is why they lose the round.
Thank you very much. To conclude the debate, I welcome the affirming leader.
Okay, all right. Hello, everyone. I'm going to start my speech. In 3, 2, 1, and go. Volatility is a scare tactic from the negative side to make you think that you have no alternatives, when all they are really doing is reinforcing a predatory banking system that also provides you with the notion that you have no alternatives other than this bank. So this debate is not about whether we should talk about volatility versus stability being good, but about whether we are satisfied with the risks embedded into the traditional banking financial system that we have today, that is centralized, that we said is embedded with the risks that happen because of its self-reinforcing nature. So I'm going to ask two things. Number one, what are the mechanisms that we provided to demonstrate that decentralization improves the entirety of the financial system? And number two, what are the defenses that they provided for centralized banking systems? So firstly, on the mechanisms we provided for decentralization being improving. At first, we explained that this improves the crypto market itself, and it improves the centralized system itself. That the risk self-corrects itself through the mechanisms of competition between startups and programming platforms, competition between lending products to reduce prices and reduce market risk, and innovation through the experience in trading and continuous exchange. And thus, because different banking systems or large banking institutions have the incentive to also adopt cryptocurrencies as well, everything eventually becomes more and more stable because more and more consumers and more stable institutions with stable credit ratings are also adopting into this market as well. Their response is to say, again, I think they rely on this response a bit too much, and they repeat that reply. They compete to scam people. The crypto scams and the professional criminals and all of these things will still exist largely on their side. But this is a generalization of all crypto providers, since the technology is becoming more known as well. And we said information gaps are broken apart, or at least they're remedied significantly as this rise and advent becomes more and more accessible to more and more people. Like they said, computers is difficult to access. The internet is the most accessible thing in the developing world right now. I don't know why that is untrue. At second, we explained that developing country stakeholders, central banks, and businesses can choose their level of exposure to these crypto exchange markets, which is one way to cushion and absolve them from the risk that is inherent to over-relying on the dollar exchange market. And their response is that the dollar will always be more reliable. But the argument was not about whether we should have the dollar or a crypto. The argument was the inclusion of crypto exchange markets and the decentralization provides developing countries with more flexibility against the volatility of the dollar, and the Federal Reserve's actions increasingly exposing them to more inflation that the Federal Reserves of those domestic countries cannot control. So the crux of the argument is that the Federal Reserve acts against the interests of developing countries, and we mitigated this by proving the increasing access of cryptocurrencies across the developing countries makes it a safe haven in the short term. Worst case, the safe haven that allows them another option to go to outside of fiat currencies because it's decentralized. But we also prove that this mechanism improves the protection that decentralization makes, provided that there are incentives to include the sale of these assets denominated in decentralized markets as well. Yes, I know I say too many economic terms, but I know it made sense at some point. These mechanisms need to be compared against the inherent volatility and the risk of embedded into the traditional banking system, the risk of risk pooling and bubbles, the risk of non-transparency because they hold so much market control over your loans, and the risk of them constantly reinforcing themselves into regulatory institutions because they have no other option other than the large central bank or other than the large bank that is already colluding itself. So they can't say we have competition, but then on our side, like, you know, like they can't fiat away collusion between crypto scams as well. Like in their model, we said they're more vulnerable to collusion because of the fact that they're the only option. The defenses that they provide of larger banks being able to afford to take more risks is just in and of itself, it reinforces the fact that they are able to justify those risks that they are putting consumers that they do not consent themselves into, the volatility they themselves do not want to be immune to. So we say that because they cannot defend centralization on its own in the absence of the improvements that decentralization provides and their lack of response to this, it proves that government has to win.
Thank you very much for the excellent debate. Say nice things about each other, and I will call you back in for the oral adjudication. Thank you to both teams. I think, honestly, this was an advertisement for Australs debating. It was an incredibly complex debate, which made it difficult to judge. Each of the different speakers, we thought, brought a lot of richness to the debate. And I will obviously not be able to canvass all of the arguments to the degree of detail that the teams were in order to give an oral adjudication that is able to be followed after a debate of that complexity. But in the end, I thought it was a clear debate. It was a split decision, and the result went to the negating team. Congratulations. One small bit of general feedback, and that's that the time scale in a debate like this is often quite important, and I would have liked teams to more explicitly explain what they think the overall trajectory of cryptocurrency was, not just in they might solve some of the limited issues, but to what degree them then solving those issues allows them to gain a greater foothold in the overall development of the system. And I think that that's important because it would have allowed particularly the Affirming team to offset current harms against the future. Current harms against a future possibility of things getting better. So that just should have been dealt with more explicitly by the teams. So to walk through the debate, the Affirming team sets up a problem with banks and with very small crypto markets. And that's that they're often exclusive or the very small crypto markets are unstable. There's a little bit of a fight over the definition of advent and what that means for the relative burdens of the teams, but I think this sorts itself out in the debate. Crypto markets are likely to be much smaller, likely very insignificant, which much less exposure for individuals and obviously being much less of a challenge for the centralized system. I don't think it's necessary to determine whether they no longer exist at all. They are just substantially less important in this world in either case. What I think the negating team is able to do is explain that decentralization intensifies the problems of the centralized system that are brought up by the Affirming team sufficiently for me to give the debate to them in a relatively clean way. I'm going to start by addressing two small certain harms that I think the negating team were able to establish in the debate that I nonetheless think were relatively unimportant compared to the risk to individuals and overall financial markets. And that was the effect on the climate and the effect on committing crimes. I think the negating team is able to establish that there is going to be some increased carbon emissions due to the fact that cryptocurrencies are more carbon intensive due to the ways that they are decentralized than centralized models. They explain that this looks like the amount of emissions that come from the nation of Chile. I don't think that this is able to be demonstrated to be marginally important within the debate. I think these cryptocurrencies are likely to get better because consumers have an interest in having fewer carbon emissions. At the reply, there's an attempt to weigh this in explaining that this is a particularly important time to deal with climate change, but I don't have, as a judge, a very intuitive feel of how much of an impact this will have on the overall effect on climate change. And in the context of the overall global economy, I'm inclined to think it is relatively limited. In terms of then crime, the negating team again attempts to convince me that this is of incredible importance, but they do so in a way that I don't think is overall in the end compelling, because what is told to me at first negating is that any extra crime will not be worth this. I don't think this is true. Hundreds of things that we do increase the risk of crime that nonetheless are worth it. And what I accept there's going to be an increase in the crime that happens. Maybe there's some funding of terrorism, but it's very difficult for me to weigh how big this change is going to be or why it is important relative to the hundreds of thousands of lives that are affected by the fluctuations of markets and the overall health of a financial system. So both of those harms, I think, are demonstrated. It does produce emissions. It is one of the big use cases is it's really easy to commit crimes on it and to launder money, but those pale in insignificance compared to the main clash in the debate. So what is the effect on finance? I'm convinced by in fact, both teams that what we're trading off here is the relative importance of consumer choice and the increased competition that comes about with having these cryptocurrencies and the inability to effectively regulate these markets. And what I'm convinced of by the negating team is that people would, in the end, be unlikely to effectively manage risk. And that there is significantly strong status quo competition within the safe zone of regulation, and that leads to the best overall balance of individual and systemic risk. So the first thing I'm going to address is the interaction between the centralized system and the decentralized system in the advent of that decentralized system. And I'll note that there was an attempt by the negating team to say, we've got all this wasted effort in crypto that we could have put into improving the centralized system. I didn't accept this as doing much for the debate. I don't think the problem that exists, as is pointed out by the Affirming team, with the centralized systems is not enough workers in the financial system or not enough finance bros trying to solve those issues. Instead, I think what is able to swing me is the systemic differences between centralized and decentralized systems. So what am I convinced of? The negating team is able to push back on the idea that there's a massive increase of competition towards a centralized system, mainly by pointing out there's significant internal competition within that system already. And that blunts a lot of the effectiveness of the Affirming team's case, because if I believe that individual banks are competing against each other and individual central banks are competing against each other, absent collusion, the large margin of the gains that you can extract from that type of competition have already been gained within the system. There is, of course, maybe some edge cases where crypto is able to pose a unique challenge to the access to the actions of banks, and I'll address that more when I talk about access. But for the overall product, I don't think there is a particularly stronger incentive. So what does then the negating team convince me of in terms of the risks? Because obviously when you have less competition, and there is less competition, there is more of a risk of consolidation. But what the negating team explains is that there are significant incentives for the government to curb this danger. They make it illegal to do particular types of risky behavior. They put in safeguards to stop the cascading harms. And beyond just the government's interest in preventing these types of financial crises or rug pulls, or any of the other ways in which they establish that crypto and decentralized systems are vulnerable, vulnerable, established firms also have a very different set of self-interest to these types of newer establishments that rise, or not necessarily establishments, but newer networks that arise in these decentralized systems. I think the Affirming team is able to make back some ground here by pointing out that one of the unique differences between centralized systems and decentralized systems is the degree of integration and regulatory capture that they can achieve with the government. I don't think this is sufficient to overcome the very strong incentives on governments to actually do their best to try and manage this risk effectively, because of the large consequences of failing to manage that risk effectively, which sometimes leads to things like the GFC. There were a number of things that I don't think were able to be established as being unique to centralized systems from the Affirming team. So for instance, risk pooling behavior, information asymmetry, dodgy internal trading, and collusion, I didn't accept would be particularly stronger with decentralized versus centralized systems. I think the too big to fail challenge that is levied by the Affirming team is unfortunately parried within the debate, because the negating team claims that actually too big to fail is a good thing because it is consumer protection when these types of systems go down. And on the comparative, you just have FTX going down and taking lots of consumers with it. But I accept that there is some weird incentives, neither team really giving me enough analysis on this point to push it one way or the other. So what is really able to swing this for me is, while I accept there is some more regulatory capture, some more coziness with the revolving door that exists between existing financial institutions and the government, the inability to be effectively regulated in a decentralized system that is first set up as being about reversibility in the first negating speech, but then becomes about the overall ways in which you stop risky behavior and you make sure that you have safeguards against risky behavior put in place, means that I accept that there is a substantially increased amount of risk to consumers and the market in these decentralized systems, especially compared to, I think, maybe some less concretely established attacks from the Affirming team on these original centralized institutions. And it is pointed out by the negating team that yes, while the USD is set up to serve US interests, the fact that it is backed by the United States government and the United States economy, and pointing to the empirical thing that I think average reasonable reader would know, looking at the volatility of the US dollar versus the vast majority of decentralized systems, means that it is going to be much more volatile. How then is the Affirming team then able to claw some more room back into the debate? And I'll note is I don't think this material is necessarily particularly strong, but the negating team, I think, doesn't engage with it in a way that is particularly effective. So what the Affirming team claims is that you're likely to have, firstly, education and an increase in people's ability to individually parse and approach risk, and secondly, more diversification. So even if individual decentralized institutions are vulnerable to particular shocks, there's likely to be more diversification of risk, both by the market and by individuals making these decisions. Why did I think this is not enough to overcome the significant increase in risk? Because while I think that some individual consumers, because they're in a more risky environment, are more careful and seek out decentralized systems that they trust, a lot of these people are going to be unsophisticated, and it is not explained to me why it is sufficient. Well, of course, I think like Goldman Sachs will be able to effectively balance at risk. This also need to be explained why the majority, like a large majority or a substantial majority, is able to sufficiently parse risk to protect them as much as being invested in traditional institutions will be. And I think that while the negating team doesn't address this explicitly, what they do is characterize very strongly the types of risks that decentralized services have. And I'm convinced that these are largely unpredictable risks. Things like three-party services going down, things like hacking, things like not understanding the leveraging that exists within a particular market, means that I'm not convinced that individual consumers will be able to protect themselves. This cleans up the debate and allows me to assess the final things outstanding from the Affirming team's case. The first of those is access, and I think this plays out into two different strands. One is access to transactions, and one is access to loans. On loans, I think there's effective responses from the negating team to point out that loan giving behavior is basically subject to a profit calculus or a self-interest calculus. And yes, there may be some people giving out more bad loans, and that then has some systemic risks, as also pointed out from the negating team, where these bad debts cascade. But most of the time, even in a decentralized system, people will not be wanting to make bets that they cannot trust they can get a return on. In terms of transactions, there's some suggestion that this is going to decrease transaction costs for individuals, but it is not established really why decentralized systems has less transaction costs than a centralized system, especially considering that you still need to be able to access things like a computer or a cell phone to engage in those types of services, and there's significant competition already to try and build access as much as possible with existing financial institutions. So what I'm convinced is that the access that increases for people is actually just access to risky betting. And this is, in the end, a little bit circular, because it's predicated on these being good dependent investments, or ones that can be made so by individual behavior. And I'm not convinced, as I explained, that this is going to be the case. This is also explained through, I think, a different lens, but nonetheless resting on some of the same assumptions with developing states rather than individuals that are able to use a crypto intermediary than a dollar intermediary and decrease their transaction costs. Once again, I don't think this is fully established in the debate and are less exposed to the shifts in the dollar of American interests. But because I'm convinced that these crypto institutions are going to be much more volatile than something like the US dollar, much more difficult to predict when it goes wrong, and much more difficult for governments to effectively prevent aggressive risk-taking behavior or put up safeguards in the light of that aggressive risk-taking behavior, it's either unlikely going to be to challenge the USD, in which case I should discount this point, but if it did for certain countries displace the United States dollar, it would be extremely dangerous to those countries because of the volatility of that market. I apologize that was a longer adjudication than normal, but this was an incredibly complex debate, and I needed to give it full credit.